Hey everybody, welcome back to another edition of the Free Toaster News Pod. I'm Carlos Caro here with co-host Nick Madrid. This week's top story is one I think every partnership lending person should take a look at. Pagaya has sued Klarna in Delaware federal court. So the headline version of the story, so Pagaya, for those of you unfamiliar with Pagaya, they're an AI underwriting company that powered Klarna's subprime point of sale lending. So you can think of that as like a buy now, pay later context. And they're saying Klarna used their model and data to build a competing capability in-house and then cut them out. Nick, what have you learned about this story so far?
Yeah, so let me do a quick summary that I found interesting. And I kind of nerd out when I get to these court docs for some reason. I just think you learn so much. So Pagaya filed on May 13th, trade secret, misappropriation, plus a stack of breach of contract claims. And the relationships goes back to October 2022. And the complaint is blunt about where the starting point is. And before that, Klarna couldn't profitably underwrite the subprime borrower. And to frame why that market is worth fighting for is that this point of sale lending, or buy now, pay later, that category exploded during the 2017 to 2021 e-commerce boom. And then per TransUnion data, and all of this is cited in the complaint, 86.5 million Americans used point of sale loans in 2024. That number jumped to 128 million in 2025. It cites that more than half of Americans have used it at least once, and the majority of those borrowers are subprime or deep subprime. Exactly the segment that Klarna couldn't serve on its own, and exactly the segment that matters to big merchants like Walmart. And then here's the part where I think is most interesting, and it's an analogy I keep coming back to. And this is how I think about it, for example. Obviously, I could be wrong, but the allegation isn't simply that Klarna photocopied the model. I actually think it's closer to what DeepSeek did with OpenAI, where you don't really need the inputs, you just need the outputs. You don't need to know the underlying model. So you feed the model inputs, which you know, and then you watch what the outputs are, and then you train your own model on that input-output relationship until it proxies the original. Again, this is my interpretation of what was happening. There's a bunch of redacted stuff in the complaint, so there's a lot we don't know. And the complaint's word for this is distillation. It says that Klarna distilled Pagaya's core underwriting technology for point of sale loans and then willfully misappropriated trade secrets. So even if Klarna believes it only ever touched the derivative of the model, never the model itself, I would think Pagaya's position is that crossing that line still violated the commercial agreement. And that nuance, I think, is the whole technical heart of the case.
Yeah, no, it's a fascinating nuance, Nick, with the straight copying or photocopying language that they use versus like inferring or imputing with AI. I think this is like a new class of lawsuit maybe that we're going to see over and over the years. Before we go deeper onto this story, I want to thank our sponsors, so Bulldog Media Group, Fintel Connect, and Spinwheel. And I just want to leave listeners with an idea, a little more about Spinwheel in case they're not familiar. So with a single call to their dev-friendly APIs, Spinwheel can give you comprehensive connection to your consumer's financial accounts, verified real-time account data, PII, and the ability to make payments across all major debt categories, all inside your own brand's experience. If you're trying to improve application page conversions, these are the people to talk to. The link to them is in the show notes. The other thing I recently learned about Spinwheel, their CEO posted this on LinkedIn yesterday, Nick. I thought it was pretty cool. What they're seeing with one of their APIs that connects to debt is that as people are going through a personal loan and they're able to see what debts they have in real time through the call on Spinwheel, their average loan amount's actually increasing. So not only is the friction in the funnel decreasing, which is, I think, their stated goal, but it's actually the information they provide to the users encouraging bigger debt consolidation loans, which is good for the consumer because they're saving on APR, and it's good for the lender and the publisher because the transaction sizes increase. This is the first time I'd ever seen that. So I thought that was a pretty cool thing. But Nick, back to Pagaya.
Cool. Thanks, Spinwheel. You help keep the lights on. So, what Pagaya actually says it's protecting, I think, breaks into three categories, and this is pretty well laid out in the complaint. And I think they're worth naming. So one is the model itself, plus the techniques used to train it. Pretty simple. Two is the data the model generated across 4 years of live lending decisions. And the complaint is explicit about why that is so valuable. Generating the actual performance history used to train the model and improve a predictive model requires, quote, lending actual money to actual borrowers. Some loans will inevitably fail and some will succeed, as is necessary for the model to learn, end quote. You can't shortcut that. And Pagaya says it, quote, invested tens of millions of dollars in hard capital to build, train, and improve the model, and it's put over $100 million of its own at risk to refine it. That's actually getting real data from loans to refine their models. And the third category, I think it's interesting, maybe not so much for our audience, but it's worth sharing, is for the capital markets people here. So, it's how you package the subprime point of sale loans into securitizations and forward flow deals that actually earn investment grade ratings. That's what they claim to be able to do. The complaint says before Pagaya, Klarna had not previously participated in securitizing subprime point of sale loans, and that Pagaya built this knowledge through real transactions. 2 point of sale securitizations that earn investment grade ratings from Kroll based on demonstrated performance. So I think that's important. Those are the 3 things that they're trying to defend for. And then the timeline, which the complaint frames as an escalating in bad faith. So this is just get your popcorn out for the complaint kind of moment here. So by May 2025, Pagaya had publicly launched a $1 billion plus securitization program with Klarna. And then when Klarna announced its Walmart partnership, the CEO called it a huge vote of confidence for Klarna's capabilities. And then by September, Klarna IPO'd at roughly $15 billion. And the complaint says that the growth was fueled in significant part by Pagaya's contributions. But Pagaya alleges that in Klarna's IPO disclosures, Klarna described its underwriting capabilities as its own. But in reality, what Pagaya is claiming is that Klarna was distilling Pagaya's model data and other trade secrets. And in February 26, the earnings call, the CFO said the strategy was to drive more transactions within our own rails. And Pagaya read that as that was the exit strategy said out loud while they were allegedly still being pulled into negotiations to deepen their relationship. So it's not just, they took our stuff. It's they took our stuff and acted in bad faith while we were doing this. And then one important thing, all of this that I've read and shared is really just one side of the story. This complaint is advocacy written to persuade a court. Every quote we just read is Pagaya's framing. Klarna has called the suit without merit and said the termination was contractually permitted, and the answer has been filed. No answer has been filed. Discovery hasn't started, and the internal communications that would actually prove or disprove distillation are exactly what neither side has shown up yet. So honestly, this is a hard one to call without deep knowledge of lending and the models, and it's a very technical case. So these are the allegations. Klarna disputes them, and a court, will ultimately decide. Okay, so Carlos, here is the question that I want to put with you, because I know you have a strong view on this. Why does this matter to people listening? Why does this matter to our audience? And what's the takeaway that you want them to leave with?
Yeah, no, it's I've been thinking about this one ever since it hit the wire yesterday, and I think the knee-jerk reaction for most lenders is, and I imagine for a lot of maybe even legal and compliance teams, is holy cow, I should get a lot more cautious with who I share my underwriting with. I think that's the knee-jerk reaction of if you kind of look at the case, maybe even in particular with fintechs potentially, and there may be some merit to that, but I think for a lot of folks in our audience, when we're talking about sharing an underwriting model, it's usually not with another lender. It's typically in the context of sharing it with a distribution partner, like an affiliate marketplace. So somebody like Karma or Experian or Maniva or someone in the category that hosts your model with the explicit purpose of finding the customer base for you that you want to acquire. So I think in that context, it's a little bit different. The Pagaya Klarna thing, it's lender to lender. So when your primary partner's primary business is lending, I think they have a little bit more incentive to take what might be considered trade secrets and run with them. Versus when you're working with a marketplace, they don't have lending businesses. Karma doesn't have a lending business. Experian doesn't have a lending business. I don't think they have a baked in incentive to take that model, run with it, and start lending money against it. I think their incentives are more to create a fair playing field for other lenders to compete, for their customers to get great offers. So I think it's a fundamentally different um, economic structure. And the other thing to note is the market's actually moving the other way. There are more lenders day by day, month by month, getting comfortable sharing not just some of their underwriting, but every detail of their underwriting, the attributes they use, the exact model, the exact scores, and hosting it with these platforms. Because it's hard to compete for attention in the Karmas and the Experians of the world. And if you're going to compete for attention successfully, your marketing funnel has to be dialed in. You have to have the highest possible approval rate, the highest possible application rate, the best possible products. And it's going to be really, really hard to do that if you're one of the holdout companies that isn't willing to share your targeting / your underwriting with the distribution platforms. So I would think about maybe a regional bank, a credit union, someone in that tier, because a lot of the companies in that tier haven't yet gotten comfortable sharing their underwriting models with these platforms yet. I think that's probably the next wave that's going to be coming in the next, call it 2 to 5 years. If someone on their compliance teams reads this headline and says, see, this is why we shouldn't be sharing with these kinds of companies, I think that's actually the wrong conclusion. It might mean you have to tighten diligence and contracting. It might mean you have to think harder about how the information's stored. So there might be a little bit more due diligence, but moving the other direction in like a really cautious position feels like the wrong reaction to me.
Cool. So I think if there's one thing, to carry out from this episode for our listeners, it's the distinction you made, Carlos. This Pagaya Klarna fight is actually like lender to lender, and it shouldn't become a cautionary tale that makes you pull your underwriting back from marketplaces. The sharing that powers Credit Karma, Experian, Engine, Monevo, and all the rest, is what's driving approval rates up and ultimately serving more customers. And so the lesson isn't share less. It's know who you're sharing with, write the terms accordingly. And the full breakdown of this, this court case and all the filings, are linked at the latest edition at thefreetoaster.com.
Yeah. And Nick, one more plug, because this conversation we're having around data sharing is actually really pivotal and central these days between publishers and lenders. And we're bringing that group together on September 23rd. It's going to be 150 leaders who are in the affiliate marketing kind of industry and it'll be roughly 50-50 lenders and publishers. So if this is a conversation you'd like to have with your publishing partners, with potential new partners, this will be a great forum to have those kinds of discussions. And I think underwriting is definitely on our docket for content. We're going to be talking about where we think underwriting is going, what data lenders are using, and this whole topic of what's the right way to share. I think this could be really interesting. It hadn't previously been on my radar, Nick, as a topic of conversation, but it might be really relevant given what's going on here with this particular story. So if you'd like to learn more about that event, you can check us out at events.thefreetoaster.com for more information.
Cool. So if you found this useful, please forward it to a friend or a colleague. We see the shares, we see the listenings, we see the opens. That's what fuels us. That's how the toaster grows. And that's our ask to you.
Awesome. Well, thanks for listening, everyone, this week. Nick, I will see you next week.
Thanks, Carlos.